What if I told you that some of the biggest loans in America today no longer come from traditional banks? That the companies funding major projects, business expansions, and even consumer credit don't even have banking licenses? Behind the curtain of Wall Street, a new powerhouse is rising quietly but rapidly. It's called private credit, and it might be the most important financial revolution you've never heard of. In today's video, we're going deep into how this form of shadow banking is changing everything from how businesses borrow money to how investors earn returns. Could it be a smart financial innovation? Or is it a ticking time bomb, waiting to explode? Stay with us as we uncover the truth. To understand private credit, we need to rewind to a moment that changed everything. The 2008 financial crisis. It was the era of subprime mortgages, speculative investments, and excessive risk-taking by banks. When the bubble burst, the world watched major financial institutions collapse. Names like Lehman Brothers became synonymous with failure, and the global economy was plunged into chaos. In the aftermath, regulators clamped down hard on traditional banks. Laws like Dodd-Frank were enacted to impose stricter lending rules and capital requirements. Banks were forced to pull back, becoming more conservative in how and to whom they lent money. But here's the thing, just because banks weren't lending didn't mean the demand for loans went away. Companies still needed capital to grow. Real estate projects still needed funding. Private equity firms saw the gap and moved in fast. Enter private credit. Firms like Blackstone, Apollo, KKR, and Ares began to lend directly to companies, bypassing banks entirely. They raised capital from insurance companies, pension funds, and ultra-wealthy investors. They offered higher returns than traditional bonds or savings accounts, and they didn't have to deal with the same red tape as regulated banks. So what exactly is private credit? In its simplest form, it's when a non-bank entity lends money directly to a borrower. These loans are typically not traded on public markets and aren't subject to the same disclosure or oversight as publicly issued debt. Unlike banks, private credit lenders don't rely on customer deposits. Instead, they raise money through investment vehicles, often structured as private funds. These funds pool capital from institutional investors. Think large pensions, endowments, and insurance companies. Private credit is flexible. These lenders can tailor terms to suit the borrower's needs. They can move faster than traditional banks, and they're often willing to take on more risk in exchange for higher interest payments. This approach has fueled explosive growth. As of 2024, the private credit market in the U.S. has surpassed $1.7 trillion in assets, and Moody's projects that number could grow to $3 trillion by 2027. Let's look at an example. Imagine a mid-sized healthcare company that wants to expand its operations. They approach a bank but get turned down. Maybe the bank sees the loan as too risky. Maybe the numbers don't fit within their lending model. But a private credit firm sees opportunity. They step in, offer the loan, and the expansion proceeds. The company hires new employees, opens new clinics, and improves service delivery. Everyone wins, right? In many cases, yes. This kind of lending can stimulate economic growth, especially in areas underserved by traditional banks. But it also raises important questions about transparency and risk. Private credit is often called shadow banking for a reason. These deals aren't visible on public exchanges. There's limited information about the terms, the risks, or even who the borrowers are. That makes it hard for regulators, analysts, or even investors to fully assess what's going on. Unlike traditional bonds, private loans are not marked to market. That means their value on paper doesn't fluctuate with the market, but that can also mask problems. If a borrower is struggling to repay, there might not be a public indicator until it's too late. In the worst-case scenario, widespread defaults in private credit could ripple through pension funds, insurance portfolios, and even retirement accounts. You might be wondering, how does this affect me? I'm not a private investor, I don't run a hedge fund. But here's the thing, Private credit is creeping into everyday financial products. Some retirement plans now include exposure to private credit. Mutual funds and ETFs are beginning to tap into these markets to boost returns. That means your 401k, your IRA, or your investment portfolio could already be linked to this growing but opaque sector. The potential upside: higher yields in a low-interest world. The risk: less visibility and less liquidity if things go wrong. So, where is all this heading? As traditional banks continue to face regulatory headwinds, the space for private credit continues to expand. Technology is also making it easier for these firms to evaluate risk, monitor performance, and scale lending. At the same time, there's a growing call for transparency. Some experts believe regulators will need to step in to impose some form of oversight on this shadow lending world. The outcome could shape the next decade of finance. Private credit is no longer a side story. It's becoming one of the main engines of capital in the modern financial system. It offers opportunity, flexibility, and the promise of returns in a challenging environment. But it also carries risks that aren't always visible until it's too late. So, is this the future of finance or a crisis in the making? Let us know what you think in the comments below. If you found this video helpful, give it a like, subscribe, and hit the bell so you never miss an update. Follow us at Twin Horizons Official for more deep dives into the future of money. Thanks for watching, and we'll see you in the next one.